Hello and welcome to our discussion on accounting. We continue our previous session and previous discussion on economic value added. In the previous discussion we saw that economic value added is the excess of NOPAT over the capital charge, and the NOPAT is adjusted PAT, and the PAT plus interest into 1 minus T tax rate. And this NOPAT was calculated without making any accounting adjustments. In the same way, we calculated the capital charge by multiplying the weighted average cost of capital into capital employed, where the capital employed is equity plus debt plus interest bearing current liabilities. And that is what we saw in the previous example. The capital employed was equal to equity plus interest bearing long term liabilities plus interest bearing short term liabilities. And we can see that there is no accounting adjustment. Whatever is the book value of the assets and liabilities are also been used for calculating the capital charge. But in this session we will try to pick up an exercise where we will have one accounting adjustments. So if accounting adjustments will be there, then NOPAT will be plus minus the accounting adjustments. Plus minus the accounting adjustments. The accounting adjustments are required to convert the accounting financial statements into economic financial statements to make it to reflect the economic reality. In the same way, the capital employed will also be adjusted with and plus minus accounting adjustments, and normally these accounting adjustments in the balance sheet or capital employed are called equity equivalent. So now with this accounting adjustments, when we say accounting adjustments, because EVA is a non-GAAP number, it is possible that sometime we may deviate from the accounting policies used for GAAP reporting and make the adjustments to deviate from that to calculate the EVA. The primary objective of the accounting adjustments is to make the book balance sheet to reflect the market or to reflect the economic reality. So let us take this exercise where we have as usual an opening balance sheet and a set of transactions, and we kept the transactions limited to understand the principle. So the opening cash in hand is 312,000. Collection from the old debtors, collection from the old debtor 90%, 0.90. And the balance was given as discount. The balance was given as discount, so 10%, 0.10. So as a result, the debtors will become 0, minus 180 and minus 20,000. So the debtors become 0 because of the collection and the discount given to the debtors. Sold entire stock for 450,000, and the entire sales is for cash, and whenever there will be a sales there will be cost of goods sold, and cost of goods sold is 214. So the stock will become 0 because entire asset has become an expense. Admin expenses for the period 20,000, and we'll make the payment for that admin expenses. So an expense, an outflow of cash, no liability. Depreciation is used 10% on the original cost. So depreciation for the period is 35,000, and depreciation will increase the accumulated depreciation and no change in the original cost because we have not purchased or sold any asset in this period. Interest on the loan There's only one loan, so 0.08, so interest is 10,000, and once again we assume that interest has been paid during the period. Since all the transactions are done, we can find the profit before tax, and the profit before tax is 450,000 minus the expenses, and we assume the tax to be 30%, and the tax is an outflow of cash if it is paid. So cash transactions done and income statement transactions done, so we can find the profit after tax, and the profit after tax, if no information given, we assume that the profit is retained fully, so profit is transferred to the reserve. Now we can find the cash in hand. Cash in hand is cash available minus the cash payment, and cash payment is 75,300 and cash available is 942,000, and the entire cash will be transferred to the balance sheet on that date. So the two important items, to reiterate, cash and the profit, which are transferred to the balance sheet at the end of the accounting period. Since no other transaction, we can close the balance sheet. No change in the capital, no change in the loan, no change in the creditor. The summation of the sources is 901, and we can now find the assets also 901,700. 901,700 is the assets and the corresponding sources. Now we completed the financial statement preparation. We can do the EVA calculation now. But in this EVA calculation, an additional assumption is given that there is a market value of the asset is plant is 250,000. Now for accounting, we ignored this market value, but for EVA, we would like to bring that into the balance sheet. So as usual, let us start by doing the calculating the net operating profit, and the net operating profit for this period or NOPAT of the business is calculated. In this case, let me transfer this to here. So the NOPAT is calculated by taking the PAT and also plus the interest. Interest is 10,000 minus the tax benefits. So NOPAT is PAT plus interest into 1 minus T. So the NOPAT after adjustments for the leverage effect is 112,700. But now it's a time to find the capital charge, and since the accounting balance sheet will undergo a change, let us prepare an economic balance sheet which will recognize the market value of the assets or the market value of the sources too. But in this case, the information given that the market value of the plant is 250,000, all other things remaining constant. So capital same as the previous, reserves no change, 8% loan no change, the creditors no change, so the summation of this is also no change as of now. Cash same as the previous, no change in the stock, but plant, it is mentioned the value of the plant is 250,000. So instead of writing the book value, we'll record the market value of the asset. As a result, the total value of the assets of the business is 11,16,700. So the difference is treated as an accounting adjustment, and we give a name to that, and that is called equity equivalent. Equity equivalent Equity equivalent is the accounting adjustments. There is accounting adjustments required to convert the accounting balance sheet into economic balance sheet. I repeat, the equity equivalent is a term that we see only while calculating the EVA. The equity equivalent is the summation of accounting adjustments required to convert the accounting balance sheet into economic balance sheet. And in this case, there is only one accounting adjustment, that is the conversion of the book value of assets into the market value of the assets. All other items are same as the accounting balance sheet. So therefore, equity equivalent is only equal to the difference between the book value of the assets and the market value of the assets. Now with this economic balance sheet, we can now prepare the capital charge or determine the capital charge. The equity is equal to 200,000 plus 451,000. Equity equivalent will also be taken as a part of the capital employed, which is an accounting adjustment, and the loan is 125,000. The assumptions have given that the cost of equity is 18%, so we take 18% as the cost of equity given. The equity equivalent is also calculated at the cost of equity, and the long-term loan, the rate of interest is 8%, so therefore the cost of long-term loan is 8% into 1 minus T. T is 30%, so therefore 18% for equity, 18% for equity, 18% for equity equivalent. So the capital charge will be the rate into the amount, the rate into amount, and the rate into amount for all the three items. So capital charge is 163,006, and we can see that the EVA is a negative EVA. So first we converted the transactions into financial statements, and we use the financial statements to create or determine the EVA by calculating NOPAT and capital charge. And while calculating capital charge, we created an economic balance sheet, which is not as a GAAP requirement, but which will convert the accounting balance sheet to reflect the economic reality, which happened here by bringing the market value of the asset into the books. As a result, the corresponding difference on the sources side has been given a name called the equity equivalent. So to recap, we said that if there is an adjustment, the adjustment will affect the capital employed and NOPAT, but in this case the adjustment affected only the capital employed because no adjustment was there in the income statement. Thank you very much.